We have this monetary system in which we have two kinds of money. Central bank money, deposits created at the Bank of England, for example. And then there's bank deposits. At the very top of the monetary pyramid, if you want, are the central bank deposits. The government is on the top. If you believe wrongly that it's the banks who create all of the money, then of course you would say, well, the government is dependent on the banks. They need the pounds that they create. So your theory of politics will be a theory where you think that democracy is kind of a sham, that it's the rich who have the money and the government needs their money, and this is why things are as they are. And that's not true. That's not how it works. If you rightly understand that the government creates its own money and it's the currency issuer in the 21st century, you finance your government spending by creating reserves with a computer at zero cost, then of course this opens up a kind of new idea about how democracy should be. I mean, the argument that the government cannot pay for it because they don't have the money, that's all gone. If you're using a theory and you get into some kind of troubles, then you need to have a new theory to deal with those problems. And I think MMT is this new theory to deal with the problems that we have in 2022 and in this decade especially.
This is the MMT Podcast with Patricia and Christian Riley. Hi, I'm Christian Riley and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. Support starts at $1 a month or £1 a month or whatever the equivalent is wherever you live. And no matter what level of support you give, you get early access to all of our episodes and patron-only episodes where you can ask me and Patricia MMT questions. A big thank you to all of our supporters so far. At the beginning there, you heard our guest this week, economist and author Dr. Dirk Ehnts. And in a moment, we're going to be talking to him about his latest book, MMT Essentials. If you're new to MMT, you might want to check out our first 3 episodes for an easy-to-understand introduction. But if you want to dive in here, money as we know it today is issued by governments using keystrokes. And for the issuers of currency, governments such as those of the UK, the US, Japan, Canada, and Australia, worrying about running out of money is as rational as worrying about running out of keystrokes, which really should play into our thoughts in 2022 as we debate the price tag of trivial things like preventing our own extinction. But unfortunately, this simple truth about the way governments spend has been buried under several layers of jargon, and so we think it's getting kind of urgent to excavate it. So, drilling down into it, even mainstream sources such as the Bank of England have confirmed that here in the UK, modern money is a number on a spreadsheet at a bank with a pound sign next to it. Different symbols are used in different countries or currency areas, but the ultimate source of these spreadsheet entries are national governments themselves. Which I know sounds incredible given how many times a politician will liken their country to an extravagant shopper on the brink of bankruptcy, but that's their job, to get you to care about numbers on a spreadsheet more than actual people. And so you'll hear them talk about how the national cupboard is bare, and so we'll have to tighten the national belt and go on a national diet so we can fit into the national trousers, which, yes, are a little bit tight around the National Health Provision region, but there's no money for new national trousers because, sadly, the national credit card's been maxed out. So, these are the national trousers you'll have to wear. Grow up, the government doesn't have a magic trousers tree. But when you ask them to describe in real terms how a country that issues its own currency could possibly run out of money, you tend to find that the national dog has chewed up the national income accounting. It's almost like these analogies are constructed to obscure the fact that poverty, climate catastrophe, and health crises aren't just things that happen to us like weather, but are actually things that we can take responsibility for and even eradicate with the right understanding. So, as you heard at the beginning, there's a hierarchy of money in every nation or currency area, with the state's money at the top of that hierarchy. And then below that, we have commercial bank money, and that's the money that we use as private sector individuals and businesses. And that's where it's possible to get confused. Because commercial banks are our interface with the monetary system, it's possible to get the mistaken impression that they're in charge of the creation of our money. But truly, because of that money hierarchy, the government's in the driving seat. And getting this wrong lets politicians off the hook for the state of the national trousers, which, here in the UK, haven't been upgraded since Margaret Thatcher bought them off Milton Friedman in 1979. So, how does commercial bank money fit into the overall picture? Well, any of us can create IOUs. Whoever you are, you can do that right now. You can write a note that promises to pay the bearer £5 on demand. That note itself could be used just like a real government-issued £5 note among the people who believe it can be swapped for £5 real at any time. But that number of people could well be zero because you may or may not be able to pay those £5 when someone cashes in your note. You're not the issuer of pounds, so your solvency is not guaranteed. But what if it was guaranteed? What if the government, the legal issuer of pounds, guaranteed that every single £1 IOU that you created could be exchanged for £1 of their money at any time? That's the position commercial banks are in. They've been deputized by the government to do this, to issue credit in order to make the amount of it available to the rest of us elastic. The commercial bank deposit that you have in your current account right now exists because some of it was originally spent into existence by the government adding reserves, which I'll call central bank money, to the reserve system, or lent into existence by private individuals and firms going into debt. When the government pays for something, it instructs its bank, the central bank, to create new central bank money by crediting or marking up the reserve account of a receiving commercial bank. That commercial bank then marks up the bank account of the individual receiving the government's payment, and that individual experiences getting paid by the government as an increase in their commercial bank balance. Because this process begins with the government creating central bank money with keystrokes, and the government can't run out of keystrokes, the government can operationally pay for anything it desires priced in the currency it issues. The government has an infinite checkbook in this respect. Turning to the non-government, what limits our ability to create commercial bank money is our creditworthiness as individuals and firms and the value of our collateral. So, for example, if you want to spend £5,000 to buy a car and it's £5,000 you don't have, you can go to your bank and sign a loan contract promising to pay them £5,000 in the future. And if they deem you to be creditworthy, they'll make the loan and they'll increase your bank balance by £5,000 using keystrokes. And then after that, that newly created £5,000 is in your account and it's available for you to go out and spend. The loan contract you signed, your promise to pay your bank £5,000 in the future, can be thought of as a £5,000 banknote from the bank of you. The person you want to buy the car from doesn't accept notes from the bank of you. So you've taken it and you've swapped it for commercial bank credit, which is accepted by the car dealership. Because your bank is a regulated adjunct of government and their IOUs are guaranteed by the issuer of currency, unlike promissory notes from the bank of you. So this is how both the government and the private sector influence the level of commercial bank money in circulation, by a combination of private sector choices, government spending and taxing decisions, and, of course, government policy. 2 points to always bear in mind when you're thinking about this. One is that you can't bank at the central bank. Central banks are where commercial banks bank, and the government and other central banks have accounts there too. And the second point is that commercial banks therefore don't and can't lend out reserves, what I'm calling central bank money, to their retail customers like you and me, because we don't have accounts at the central bank. What happens in the central bank money system affects what happens in the commercial bank money system, but they're separate systems. So to sum up, commercial banks are not the government's creditors. It's absolutely not the case that commercial banks create all the money in existence and somehow our governments need to get money from them to be able to spend. That's not where the government's spending money comes from. The government has its own bank and issues its own money, and that money coming into being causes commercial bank money to come into being. When the government wants to spend, it spends its money, central bank money, into existence by typing it into existence. And that's why the government can afford to buy any trousers priced in its currency without limit. We're going to be talking to Dirk about this in a moment, but for more on the mechanics of banking and central banking, you can listen to our episodes 13 and 43. And for more on the UK payment system in particular, you can listen to our two-part interview with the authors of a landmark paper laying out an accounting model of the UK Exchequer. And those are our episodes 82 and 84. Finally, for more on the real spending constraints of governments that issue their own currency, it helps to understand inflation. And we talk about that a fair bit, but I'd recommend our episodes 65, 104, and 123 in particular. I've linked to all of the above in the show notes for this episode, along with some other things that came up in the conversation. And as ever, I've linked to where you can support this podcast financially via patreon.com/MMT podcast. Support starts at $1 a month or £1 a month or whatever the equivalent is wherever you live. And no matter what level of support you give, you get early access to all of our episodes and patron-only episodes where you can ask me and Patricia MMT questions. We're 100% listener funded. Your financial support really helps keep the show going, and your support in other ways, whether it's by recommending us to other people or just by listening and spreading the word about this stuff, really helps too. So thanks as ever for the time you put into understanding MMT. Let's dive in. Welcome one and all to the MMT podcast. I'm Christian Riley.
And I'm Patricia Pino.
And we are delighted to welcome back to the show our friend, economist and author, Dr. Dirk Ehnts. Hi, Dirk. Thanks for joining us today.
Hi, Christian. Hi, Patricia. Very happy to be back.
So, Dirk, we want to talk about your most recent book that you wrote for Springer. It's called MMT Essential, which is available in German at the moment. We're here to add pressure to the world of publishing for an English translation, because as you say in the opening, the book is there to provide a compact introduction to the theories, basic assumptions, and economic policy conclusions of MMT, which it does brilliantly. Early on in the book, you state that central banks, and even governments can create money, and that you're going to take the reader through how this works. So for the non-German speakers out there, how does money creation as we know it today work?
I think we should start from the legal perspective. So money is something which is created by law. And that is, I think, a very huge insight. I think Warren Mosler was the first to kind of reinvent this idea that money is something which the government is using to provision itself with resources. That's the main perspective on money that we should use. So the money is then created by the government, for example, because they have a budget. This budget is passed in the parliament or wherever this is passed, depends on the political system. And once it is passed, then you can spend the money. So the central bank is just executing the payments of the government. In a way, you can think about the central bank as a payments executioner for the government. That's very normal in a democratic system. So there's no institution that says we have a veto here on all the government spending that you are planning to do. So it's a democracy. So you have a majority in the parliament. You can pass the budget. And that means there shouldn't be any more roadblocks. And normally there aren't. The crisis has shown that there are no more roadblocks. So there is the technical creation of money, which is the central bank. It's the central bank's task. They are running the payment system. So they have a very large ledger, basically. So there's accounts which belong to the banks, which belong to the government and other public companies maybe. And they are able to change the numbers in these accounts. It's a little bit like if you go to a football stadium and you're watching a game and there's a scoreboard there. If it's 1-0, you don't ask the question, where's the score coming from? You just add up and you add goals to the score, and they don't come from anywhere. And the same with central banks. So when they mark up the account of someone who's working for the British government, for example, then they just mark up the account by £100, for example. These pounds are not coming from anywhere. They just typed into existence with a keyboard. So most of the people are still thinking about money as some kind of gold coin. They imagine a world in which the government first has to get its hands on gold coins, get them from us, who created them. But even if you look at historical gold coins, the gold coins were always minted by the state. Also in the United Kingdom, for example, in the 19th century, the Royal Mint did that. Nobody was doing this privately. So even gold coins are state money in a way. And the acceptance of these gold coins for payments made to the state, that's what creates modern money in a way. So, of course, there's more definitions on money. But if you're asking the question, how does the government provide itself with resources and what does it do with those resources and how much does it spend and what kind of prices does it pay, it kind of makes sense to follow the definition, which is the MMT definition of money, that money is what you can use to extinguish debts towards the government. And I think that is the core idea of MMT, that it allows us to rethink the economy, not based on money as something which you can use to buy stuff. So this is the idea of consuming, and also the idea of producers paying people wages so that they work for those companies. But instead, we should first think about money as a tool that the government is using to make sure that we get the public services that we need, and that we get these public utilities that we want, that we get the infrastructure and all these kind of things. That's really the new idea of MMT, that it kind of refocuses the discussion about money on the public sector.
One of the great things you do in the book is you put MMT in historical context. You write MMT didn't reinvent the world, rather it borrows mostly unconsciously from older economic theories or arrives at the same conclusions. For example, German economist George Friedrich Knapp, who published the book State Theory of Money in 1905, was unknown to Warren Mosler, who is the father of MMT, although Knapp's book begins with the sentence, "Money is a creature of the legal order." In the book, you contrast that with Marx's conception of paper money. Could you talk about that?
Yeah, when I went into reading MMT, I kind of thought that maybe there's going to be something in Marx, because when Marx lived in the 19th century, there was paper money, and he must have noticed. So I have to admit that I have only the first book, The Capital by Marx, only volume 1. So I just started reading it, and I thought maybe something's in there. And I started reading a little bit faster. And then I found a couple of pages where he talks about state paper currency or state paper money. And he discusses state paper money for a couple of pages. So he kind of recognizes that there is this kind of paper money issued by the state, which is floating around. I mean, he did a lot of his research in London, so he must have noticed what's going on. He knows that this works, for example, but he doesn't understand it in a way. Okay, so he says, in the end, it only works, this kind of paper money, because people think that it's going to be backed by gold in the end.
Yeah, I've actually got the quote in front of me that you pulled from Capital. Quote, "State paper money with a compulsory rate is the perfected form of the value sign, and the only form of paper money which grows directly out of metallic circulation or simple commodity circulation itself."
Yeah, so for him, he's a metallist, so he believes that the value of money comes from the gold backing. The thing is, I was just reading a book yesterday, which is published by one of the followers of Knapp, and the book is about the currency school and banking school debate in the 19th century in Britain. It's kind of funny because the author writes about, I think it's roughly 1830 or something, and he says that the Bank of England said, okay, we did not convert these paper notes into gold anymore for a couple of years. I think it was after the fight against Napoleon. So they stopped conversion from paper notes to gold. And then they reintroduced this. And the Bank of England kind of said, okay, so we expect people to show up at the Bank of England presenting us their paper notes, which we have issued. And then they will collect the gold, right? So they opened up shop, opened the door, and then in the morning, nobody showed up. It's kind of awkward because normally you would think that in the 19th century, people would prefer gold coins to paper currency, but they didn't. It was very nice to see this historical example that when people had a choice to choose between fiat currency, so paper currency, or gold coins, they said, okay, no, the paper notes are okay. We will use them. That's fine. We don't need gold. And that is something which Marx has missed. I think it's a bit awkward because even Adam Smith, who wrote his Wealth of Nations book in 1776, so Marx, of course, he read Adam Smith and he was reading David Ricardo, and he was kind of connecting to this kind of old school political economy, trying to end this kind of debate about where does it all end. But he was part of the classical economists. And because it is an Adam Smith who said something like, when the prince chooses a certain money to be used for the payment of taxes, then that money would have a certain kind of value, or it would have a higher kind of value. So Adam Smith knew about these kind of things, that when the sovereign would pick some kind of money to make payments to the sovereign, then this would be something which it's more precious than the other monies. But yeah, Marx never went there, and it's a kind of a shame.
When you kind of look through the history of money and its associations with a commodity like gold, but then you have kind of sprinkled across history these views that kind of hint at MMT, right? This idea of law as a creature of law. When was the first time that currency was referred to as merely a unit of account? Presumably MMT is not the first to say so.
People understood that the money that you can use to make payments to the state was something special. And they understood that in Mesopotamia, you have some kind of temple. They provide protection against exterior enemies, but also they kind of uphold the law. It might be well-meaning, but it might be some kind of mafia as well. It's hard to judge now, a couple of thousand years later. So they say, okay, you bring us our goods. You bring us the goods to the temple. So the farmers brought, half of their production to the temple in exchange for protection. And in order to prove that you already paid the temple, they would give you some kind of stick. Okay, one of these tally sticks, and they broke it in two halves. And when you came back with the stick to the temple, and then it was a perfect fit, they knew that you already paid your share. In that sense, money was something that came out of taxation. So instead of paying taxes in something like, wheat and natural produce, it was easier for the state to use money and to just force people to pay taxes. And this allows the government to get what it wants. So it provisions itself using its money instead of collecting, for example, 10% of all the production, which was kind of typical for the Middle Ages in Europe, where the church collected 10% of everything that was produced. So I think that this idea that money is something which you use to make payments to the state, I think that must be 500 years old at least. In the German literature, you can find books from 1500 something who mentions this idea, more or less.
You write statements by other economists have been adapted for the purposes of MMT as a kit of ideas. After their ideas were rediscovered. These include, for example, Joseph Schumpeter's idea of creative destruction in dynamic capitalism. I don't think we've talked about this before. Could you introduce a layperson to this concept?
Joseph Schumpeter he was an Austrian economist, born in what is today the Czech Republic. And he was born in the late 19th century, and he became a famous economist in the early 20th century. So he was competing with Keynes at one moment, around 1820 roughly. So who would be the brightest economist? And Schumpeter was thinking about capitalism, and he somehow understood that banks would create money also. And he kind of took the neoclassical theory and said, look, some investment is financed by saving. So there's this kind of flow of saving, which is somehow transformed into investment because the banking system is somehow an intermediate or intermediating unit. And then he said, well, there's also investment which is financed by credit. So there's going to be credit creation, and this kind of credit creation means that there will be more competition, there will be a more dynamic economy. So he understood endogenous money. It's not hard to see where he got it from. So Knut Wicksell, a Swedish writer, was publishing a book in 1898, Interest and Prices, where he clearly said that bank deposits are created by keystroke. I think he almost literally said that. Wicksell also said that there's no limit of the quantity of money that banks can create. And Schumpeter tried to make it into a theory of development. And I think this is where it connects to MMT. So we also understand the endogenous creation of money in the banking system. So they create new bank deposits when they are loaning out money to the private sector. I think that's also part of what MMT is about when it comes to the dynamic sector of the economy. And of course, Schumpeter is not writing about the liability side, which is what Minsky is doing, for example.
I'm glad you brought up endogenous money, because the story's been told and retold and a little bit warped. And now there's this story circulating out there among people interested in the mechanics of money that goes, actually, commercial banks create all the money. And to address this talking point, I found myself writing the same explanation over and over again to various people. So I thought I'd write a proper piece, which you and Phil Armstrong have been generously helping me with. I've called it, saying banks create all the money is like saying Ticketmaster create all the Beyonce tickets. Meaning the statement Ticketmaster create all the Beyonce tickets starts partway through the ticket creation story. It doesn't tell you what causes Ticketmaster to create Beyonce tickets. It doesn't tell you the ultimate source of the flow of Beyonce tickets. And similarly, if you start and end the money story with commercial banks, it doesn't tell you the ultimate source of the flow of modern money. How do you address that story that's out there?
Yeah, well, we have this monetary system in which we have two kinds of money. And the first one is the central bank money, so deposits created at the Bank of England, for example. And then there's bank deposits, so deposits created by commercial banks. And these two monetary circuits, they are intertwined. So you can ask your bank to give you cash for the bank deposits that you have. And cash you can only get if you have central bank deposits as a bank. I would always start with the Bank of England. I would always start with the question, so why is it pounds? So why do commercial banks create pounds? You cannot answer the question without referring to the Bank of England and the state and say, look, they are basically creating promises to pay in pounds. That's what they do. So when you have a bank deposit of £1, the banks promise you that you can either get £1 in cash or that the bank will execute a payment worth £1 for you. And that's what it is. You have to examine the Bank of England first to understand the unit of account. And that matters, of course. So at the very top of the monetary pyramid, if you want, are the central bank deposits. That's very important to understand. So this is why in thinking about money, the government is on the top. And the first idea that you should have when you think about money is that, yeah, money is a thing that the government uses to buy the stuff that it needs. And then, of course, we also use it to run our businesses, to run our daily lives. We have all kinds of other uses. And these two things probably evolved together. But historically, I would argue that there was first this idea that the government collects taxes or it spends money to just buy what it wants, where you have these examples also in Virginia, for example, in the 18th century, where it's very clear that they do it like this. So I would say that the state activity was there first and then commercial activity started, because commercial activity and capitalism are relatively recent, whereas the collection of taxes goes back millennia.
A lot of people, when you start telling them the story of money and the discussion about what the nature of money is and what money is, a lot of people out there will say, what does it matter? Why are we obsessed about definitions of money? Why are the MMTs obsessed with all this? What would in your view, Dirk, would be the kind of policy implications of this new view of money? And I know that you've written a few on your book, but I'd like to hear you maybe explain them a little bit more.
If you believe wrongly that it's the banks who create all of the money or almost all of it, then of course you would say, well, the government is dependent on the banks because they need the pounds that they create for the payment of taxes. And that's not true. That's not how it works. But following this idea or this kind of theory of money, then of course you would think that the government is not very powerful. If it cannot tax enough money out of the banking system, it would have to borrow money from the rich, and that makes it dependent on the rich. So your theory of politics will be a theory where you think that democracy is kind of a sham, that in the end it's the rich who have the money and the government needs their money, and this is why things are as they are. So this is maybe why the governments are like the ownership society by George W. Bush, who are catering to the wealthy and to those who have a lot of possessions. If you rightly understand that the government creates its own money and it's the currency issuer, in the 21st century, you can finance your government spending by creating bank deposits and reserves with a computer at zero cost, and all the central banks can do that in their own currency. Then, of course, this opens up a kind of new idea about what society or how democracy should be. I mean, the argument that the government cannot pay for it because they don't have the money, that's all gone. If you have a problem that you need to fix, of course, there can be a market solution. Everybody knows that. We have been working with this assumption for a couple of decades. But now there's also a possibility that there will be a public solution. If, for example, because of high gas prices, maybe in spring or summer, we would like to maybe use bicycles. And then, of course, the question is, how do you provide those bicycles? And then you can say, well, you can have a market. Firms will produce them and then they will sell them to people who will buy them, and they will be owners of those bikes. Everybody knows how this would work. That's what we do. But you can also say, well, how about a public option? Let the local government buy a couple of bicycles and then it can lend them out for a couple of minutes or a couple of hours to people, and they just pay by the hour. In that way, it's kind of cheaper because people don't have to buy the bike, and maybe it's more effective or more efficient also when you are sharing the bikes. And I think we kind of enter a post-ideological age when we understand that there's this public option always available. In neoliberalism, you only have the market option. So if there's any problem, you can only fix it by somehow playing with the incentives. And if that doesn't work, then you just try to influence some kind of market price. Okay, so CO2 emissions, they get some kind of price, and that is supposed to be the fix. If there's people with too much money, you just have to change the tax rates, and then this will be the fix for that problem too. It's kind of mechanical, these fixes. And MMT provides you with a much broader vision of what society is and could be like, because we discuss all kinds of mechanisms that you could set up. And historically, we have been discussing this quite a lot. What should the monetary system look like to have prosperous society? In the US, for example, you have a very rich history of discussion about the greenback, about the US dollar, whether it should be a gold standard or silver standard, whether the banks should accept land as collateral or not, and if so, at what kind of price. These kind of debates in the US were maybe more prominent than in the European countries. These debates, they are very important. We should discuss how our monetary system is designed, and then we should discuss what the effects of it are. So, for example, in the United Kingdom, I would think that most of the loans that banks are giving, probably about 3/4 at least, they go into real estate. Is that really something that you want? Are you sure that this is what banks are for? Then you will have rising house prices probably, and maybe these boom-bust cycles. A different approach would be to build community housing. So the local government builds houses and rents them out or sells them. There's all kind of options on the table. And I think now in 2022, after this pandemic, that we now all understand that there's no limit to government spending. There's a limit to resources, and there's a limit to the resources we can use on a sustainable basis. So we should think about solutions and how to get there, and not be ideological about it and say, I can only have a market solution, or say, I can only have a government solution. That's 20th century for me. So we tried that already. We had these kind of communist or socialist societies in Eastern Europe mostly, and they said, well, we don't want this capitalist sector. And that really didn't work out. But now trying out the opposite, saying that it will only be markets and the government is always doing something bad, so let's just leave it out. I think that doesn't work either. And I think now it's about time now to get creative and to find new solutions to the old problems that we have. I think Einstein didn't really say that, but it's attributed to him to say, if you're using a theory and you get into some kind of troubles, some kind of problems come up, then you need to have a new theory to deal with those problems. And I think MMT is this new theory to deal with the problems that we have in 2022 and in this decade especially.
So to recap what you said a bit earlier, at the moment in the neoliberal mainstream view, the government is entirely dependent on funds extracted from the private sector in order to spend. And that very often means we need approval from those sectors that give more taxes in terms of volume, in terms of quantity of value to the government, which almost always is the rich, in order to pass certain policies. So it sort of makes the government dependent on the rich, but often because the rich are perceived as the issue, the problem. At the same time, it neuters the state from taking any action against them because they are themselves dependent on it. So it's sort of a very contradictory state where you have people asking the government to do something because they're diagnosing the problem in a certain way, but that same diagnosis prevents the government from being able to do anything about it. So when MMT comes in, you have a state that actually, is by no means perfect. Democracy still has a long way to go, but at the very least, there is a means now by which to capture that state and actually take action that we need to redesign our society. Is that the right way of looking at it?
Yeah, I think that's a political perspective. So I agree that the normally the first question that you get when you propose something like, let the government do this or that, then the first question is, how are you going to pay for it? And this ends the debate quite a lot. And it's kind of accepted that this is some kind of debate ending argument.
Well, it's just an additional hurdle, isn't it? An unnecessary additional hurdle.
Yeah, it's not necessary. And MMT makes it clear that that's not something which comes out of the operations of the monetary system. So if you understand the operations of the monetary system, you could say, well, we just got to pay for it the way we pay for other stuff. We just spend more money and that's it. And then on the theoretical level, I think, and that's also very important, that when you teach about money and when you teach about economics, that you reframe money. So money is not there to have a nice business sector. To some extent, the money is there to have a dynamic capitalist sector, but you can clearly see that this dynamic capitalist sector depends on the spender of last resort, which is the government. Okay, so the US economy collapsed in 2020 when the corona pandemic hit them. I mean, you know how it is in the US, hire and fire and all these things. So they have labor market flexibility, and in a downturn, you don't want labor market flexibility. It means you have lots of unemployed people. The unemployment rate went up to more than 20% in the US in 2020. And of course, you get this kind of coordination failure. So this is the debate about whether the economy somehow finds its equilibrium. This is what John Maynard Keynes wrote about and said, look, there's magneto trouble. Okay, so if you have lots of unemployed people, they won't buy the products and services from the businesses. So that for them, it's not worthwhile to hire more workers because they cannot sell what they would be producing. So the businesses are saying, well, we would hire you, but we cannot sell more output, so we cannot hire you. And the consumers are saying, well, we would consume and buy your stuff, but we can't because we don't have work. Okay, so this is clearly a coordination failure of the economic system. And the solution is very easy. And Biden did it. He said, okay, let's spend $2 trillion. And they did. They increased government spending by 2,000 billion US dollars. And that created lots of demand again for private companies. That was how you got the American economy out of the slump. That's fundamental. Okay, without that, the private sector would not have somehow righted the ship by itself. That's not how it works. So the business sector is competing for money, and that money ultimately must come from the government, because the banks can create money. Yes, they can, but they lend money. And that has to be repaid. So over time, the net creation of banks is very close to zero, because all the money they create through lending, they get back because the loans are repaid after, 5 years, 10 years, maybe 20 or 30 years, but then it's repaid. The only economic unit that you have in your economy which is able to sustain some kind of impulse, some kind of injection of money is the federal government. And that is why you need to rethink the role of money and rethink the whole monetary system, and you need to rethink capitalism. And I think we didn't realize it yet that this is what we have to do. But MMT is just the start of something bigger, that we have to reimagine the way that our societies, including the economic part, works.
On that topic of banks can loan money into existence, but it's offset by the amount of debt that is created in the private sector simultaneously. Once you kind of get over the hurdle of, okay, there's a hierarchy of money, when the government spends, it types central bank money into existence, and that causes the level of commercial bank deposits to go up. The causality is central bank money going up causes commercial bank money to go up. Once people start to understand this pyramid where you've got central bank money at the top and then commercial bank money underneath, there's a more evolved version of the banks create all the money story, which is that, okay, I understand that, but still commercial banks create most of what people call the money supply, something like 92 to 95%. How do you answer that charge?
Again, I would refer to this very clear example of the US in 2021. The economy was in shatters. The creation of money by banks, it just depends on the demand for loans from the private sector. And then the question is, so what is driving the demand for loans from the private sector? And the answer to that should be it's government spending. So if the government spending is high, then there will be lots of loans, because the businesses, they will collect contracts from the government, and they don't care about the price. Okay, so look at the 1980s in the US. You had the Reagan government with this idea of Star Wars, okay, trying to move the whole Cold War concept into space and build laser weapons and all this kind of stuff. So when you get a contract from the US government and it's about defense or attack, these defense contractors, they know that the government will pay any price they will put on the invoice. They will not say, well, we could get this government contract, $200 million, but we would have to take out a loan at a 6% interest rate, maybe for, 20 million. And they say, well, the 6%, it's really too high. It's like, no.
Yeah.
If it's 6%, then you just charge the government more and say, look, in order to produce the stuff that you ordered, we had to get this loan. And that meant that we have to pay more interest, and we put this interest on top of the price, and then we put on the markup as well. And then the capital costs in a way, so the interest that you pay on the loans, it's a tiny fraction of the total price. And that is, I think, what is very, very important to understand, that when the government doesn't spend as it is supposed to, then the whole economy can collapse. We did it in the Eurozone. In Greece and in other countries where the austerity policies were imposed, you could clearly see what happens when the government starts to spend less. The economy collapses. And that's the empirical picture. There's no success story at all in the Eurozone. Not one of the austerity countries somehow is now a star economy. And that happened 10 years ago. So if Greece didn't come out of the slump after 10 years, if Italy still has a GDP which is lower than in 2007, well, then these kind of policies don't work. If you want to have a better economy, you have to increase government spending until, of course, you hit some kind of wall and you see prices starting to go up and these kind of things. So when you have an inflation across the board, right now what we are seeing is the energy prices are going up. We don't see this kind of inflation. We don't see wages going up, for example. We should always point out that the only economic unit in the economy that is allowed to spend without having to pay back, that's the government. So in this game of monopoly, if you want, it's the bank which is injecting currency into the game. Everybody else is just redistributing currency. It's the government bank, so the central bank and the government together, they make those money injections, and that's important to keep the game going.
You mentioned something important, which is the Eurozone. A lot of the examples for a government working in tandem with its central bank and creating money as it spends is given from the UK perspective. What is different in Eurozone countries? Because, I mean, technically Germany, Italy, Spain, they all have their own central bank still. What has changed fundamentally in the relationship between their central bank and their government that they're no longer able to do this anymore?
No longer able to do what anymore?
To work in coordination in the way that the UK and government and its central bank works. And so that whenever, for example, Italy spends money, it would be creating money. Well, whenever the UK does it, it would certainly be creating money. But in the case of Italy, it doesn't.
No, it does.
Oh, it does?
Yeah. So the way it works in the UK and the way it works in Germany, for example. So I don't know really about Italy. I just assume that it works just like in Germany. But in Germany, when the government spends, the federal government, they just wire their instructions to the central bank. Then the Bundesbank will check whether the account of the German federal government was at 0 or more in the beginning of the day at 8 o'clock. And if that's the case, so if the government is not in the red with their account at the central bank, the German central bank will pay all the bills of the federal government without any limit.
The German central bank?
They will kind of mark down the account of the federal German government. For every 100 euros that they spend, then they subtract 100 euros from that account. And if it goes below 0, then the German government would have to top it up to 0 again. Okay, so if you're negative minus 200 million at the end of the day, you can offset those negative amounts with positive amounts that come in via tax revenues. But this is just a number, okay? That's not money. It's just a balance. I think balance is the best word. It's like a computer game score. Because the German federal government, when they have deposits at the German central bank, that's not money. Because money is a tax credit, okay? So money is what you use to make payments to the state. But the state, of course, cannot make payments to itself. So what does it mean, for example, when the German government has, I don't know, 1 billion euros in the account of the German central bank? Is that debt? No, because there's no maturity. Does the central bank offer to transform these 1 billion euros into anything like gold or foreign currency? No, it doesn't. So it's not money, it's just a balance.
You put it really well in a tweet a couple of days ago. Deposits in the account of the government are not money, a tax credit. Just as a cinema ticket in the hands of the owner of the cinema is not a cinema ticket. IOUs only emerge when owned by someone else. Otherwise, it's just paper.
That's exactly the analogy. If money is an IOU, then if it's in the hands of the issuer, then it's not an IOU. Otherwise, you could just print yourself an IOU and say, the owner of this piece of paper will get £1 million from Christian and Patricia. And then you are a millionaire because you have that piece of paper. But of course, you're not a millionaire because it's an IOU and it's in your own hands. So it's not worth anything. And if you don't put any maturity on it, it cannot be worth anything if you hand it out to somebody. If I have this piece of paper saying Patricia and Christian will pay you £1 million, I will come to you and say, look, can you pay me £1 million? And you say, well, yeah, we know we owe you £1 million. We'll pay you sometime in the future. This will be a running gag then, or some kind of joke that we will always be able to play with each other. But of course, at some point you will both die or I will die first. And that will be the end of it. Okay, so if there's no maturity, there's not going to be any debt.
Sorry to kind of keep on going through this route, but what is different? Once the Central Bank of Germany has this negative balance, what is different? Is it that there is a legal requirement for that to be converted into bonds? What can't the German central bank do that the UK central bank can do?
I would say nothing. The big question in terms of can you spend more money if you are the German government? So what can go wrong? Tax revenues can fall in a crisis. The German government just spends money, and then tax revenues drop. And they note that they have some kind of deficit, so they need to sell bonds to have some kind of bond revenues to offset these deficits, which they have in their account, so that the next morning the German central bank will spend again for them. If there's no demand on the primary market, so there's a couple of banks, 30-something, who are the only banks who are allowed to buy German government bonds from the German Finance Ministry, which is done in Frankfurt, and it's done via some kind of institution, Deutsche Finanzagentur, so the German finance agency, which belongs 100% to the German Finance Ministry. They do the actual selling. So as long as you can sell bonds on the primary market, there's no way that you can run out of money in the Eurozone. Germany, which runs a current account surplus, everybody knows that Germany is rich as a country. So there's going to be lots of money. The economy is doing well. Before Germany goes down in an economic crisis, other economies will go down. It's kind of a safe haven. You always have to be a safe haven only relative to the other countries. So the setup of the Eurozone is a bit awkward.
It's a bit like they're in competition constantly.
Yeah. And this means that for countries like Germany, I mean, yes, on paper, they lost their sovereignty and they can run out of currency if the bond market stops buying their bonds. If they do, it would depend on what the ECB does. So if the ECB has some kind of asset purchase program, which they always had since 2012, then the ECB is buying up German government bonds on the secondary market. Then on the primary market, the banks will understand, okay, so if we buy bonds from the German government, we can then turn around and sell them directly to the ECB for a better price. Is that correct? And then if the answer is yes, then even in the Eurozone, the government cannot run out of money. That's what we had in terms of a change of rules in March 2020, when the ECB created its pandemic emergency purchase program and said, look, we're going to buy, I think it was at some point about 2 trillion euros worth of government bonds and other financial assets. But the ECB more or less said in their press notes also, they said, well, we will buy government bonds to the extent necessary during the time necessary to make this thing work. So we ensure that the governments do not run out of money in the pandemic, because that would be a disaster, right? And they also then said, okay, we have some kind of escape clause in the Stability and Growth Pact. Normally, there would be the problem that if the German government spends too much money, too much, of course, hypothetically, they would have a deficit which is then above 3%, which is the limit. And if they go above 3%, then of course the European Commission could impose austerity on Germany. But you have to understand that I think in 2019, there were 10 countries in breach of the Stability and Growth Pact. So 1 year before the pandemic hit. And only Romania was punished. The fiscal rules of the Eurozone are bad. There's no debate about that. So the fiscal rules don't work. And the workaround was that the European Commission doesn't enforce them.
It doesn't enforce them selectively, or am I wrong? Because, I mean, was there a political reason for not enforcing them in each? Presumably, they didn't just forget to enforce them.
No, it's all politics. Okay, so the European Commission, of course, it's a powerful body. They have this democratic deficit, so it's not a European government. We don't get to elect those people directly, and it's a bit obscure. And also, there's no vote of no confidence in the European Parliament, and I think the Commission has to propose the laws, and there's all kinds of things that are wrong with it. So, of course, it's not a good idea to give the European Commission this authority to impose austerity on a country. I don't think that this is a good idea, but this is kind of hardwired into the euro, that the idea was that financial markets take control, and then governments who are overspending, they create large deficits, and then the financial markets will help to correct these deficits, and the European Commission will tell those countries to cut government spending. So that good countries are rewarded with low interest rates, and bad countries are punished with high interest rates. Well, and we tried that in the global financial crisis, whether we wanted to or not. And it was a disaster. Okay, so they changed the rules, and the escape clause was, I think, inserted in 2011 or 12. It was after the euro crisis. And now the ECB has also changed its idea about what its role going to be. So in 2010 onwards, in the euro crisis, it didn't buy any Greek government bonds. It said, okay, that's not our problem. It's your problem. So if the Greek government cannot sell government bonds to the banks, then the ECB said, well, we're not going to help you by buying those bonds on the secondary market. And that's how the Greek government ran out of money. And their public debt to GDP ratio, I think in 2010, was roughly 130%. And they ran out of money in the following years. Now it's 205%. Public debt to GDP in Greece. And there's no problem at all. So it's a political decision. So if the ECB is supporting the European Eurozone governments, they cannot run out of money. And if it does not support them, they can. That's where we stand.
So during the pandemic, the ECB supported the governments in a way that is pretty similar to the way that the Bank of England supports the UK government. Now, from what your other tweet was saying about basically the central bank removing the support, then we're back into a situation where the ECB can simply say no to these governments.
Yeah, now this is all very political, okay? We have a German finance minister from the Liberal Party who just said some days ago that now it's going to be back to competitiveness and deficit limits and debt brake and so on. But he's talking to his base. The very big question is what he's going to be doing. The question is not what he's going to be saying. I think we all know in the Eurozone that the fiscal rules don't work. And one of the social democratic politicians of Germany said recently that now with social democrats in control in Portugal and also in Germany and some of the Nordic countries and in Spain, that there might be some kind of possibility here to overhaul the fiscal rules. It's a very touchy subject, of course, because many politicians, they put a lot of political capital into drafting these rules and punishing Greece and so on. So, yeah, it's a political question. So I don't know what's going to happen. Of course, it would be nice to have a reform of the Eurozone. And if it doesn't happen at some point, I'm sure that some countries will say we prefer to stay out.
Yeah, I mean, I'm just going to pull a quote out of your book. Quote, with the pandemic emergency purchase program, the ECB is breaking new ground in the crisis. Now national governments are being supported, which has stabilized their government bond prices and prevented a second euro crisis. This program should be seen as a step towards normality, with the ECB coming of age and finally using the superpowers that other central banks have long been using. If the German Constitutional Court were to overturn these superpowers in a future court ruling, a change in the ECB's mandate would probably be unavoidable. So we've got to the point where they've switched off this facility, the pandemic emergency purchase program. And so I guess, where are we? What is it? Wait and see? Yeah,
well, I mean, the ECB knows what they're doing. They're pushed by politicians to shut down the pandemic emergency purchase program. And they did. And they said, okay, we still have these other asset purchase programs and we think that it's going to be fine. But of course, it's an impossible situation. So the ECB is somehow bound by law to not somehow monetarily finance those governments. And also the central banks are not allowed to monetarily finance those governments. But I mean, how do you think government spending works? I mean, the central bank is crediting accounts. It's all monetary finance. There is nothing but monetary finance. So this is why it's so tricky, because the legal basis, it doesn't support anything. If you look at the European Union treaties and you look at the ECB and the role of the ECB and the nation states, then there's a lot of talk about public sustainability, or sustainability of public debt, so the fiscal sustainability. But what is fiscal sustainability? They never define it. And this is why it's so difficult, because the ECB, it has this problem that it's a central bank which was built in the 1990s on neoliberal legal frameworks. And those legal frameworks, they don't work. And now what do? Okay, so you have just an inflation mandate. But of course, theoretically, you could say, well, in order not to have a horrible deflation, of course, we need to act as some kind of dealer of last resort in government bonds. I think it would be possible to argue like this and say, look, all the other central banks are doing it, so we have to do it as well. If we don't allow, 6 or 7 Eurozone countries to increase their government spending, and then this creates a large economic mess, of course, we will have lots of deflation. So, yeah, it's a political fight, more or less. And the ECB is trying to shift into this role as a dealer of last resort, as I call it, so that they buy up government bonds from countries like Greece or Italy or even Germany at some point, maybe, when the private market says we don't want them. And if the ECB can act as a dealer of last resort, then there's no more problem of sustainability of public debt. So then this whole Stability and Growth Pact doesn't work anymore. So that's a political fight. So those who created the euro, they don't want to see these mechanisms go. The ECB wants to see those mechanisms go. I think it's pretty clear. But they can't do it. The ECB is just the central bank. It's not the European Commission. The European Commission could easily say, hey, let's get rid of the Stability and Growth Pact. It's not working. It creates negative growth and instability, so let's get rid of it altogether. Maybe we should have some kind of mechanism which says, okay, we have to limit somehow the total spending of governments inside the Eurozone so that governments do not somehow double their spending from one year to the other or something. If that ever becomes a problem, I kind of doubt it. But that's where we stand. So it's a very complicated political situation.
Back to your book, another bullet point takeaway that you emphasize in it is that private debt is something completely different from government debt. What is the difference between those two types of debt?
I mean, if you go to a bank and you borrow £1,000, you're going into debt. You're left with £1,000 of debt. Maybe there's some interest rate of 10%. So it's £1,100 that you owe the bank. And if you want to get rid of your debt, you have to make payments to the bank to get rid of your debt. You give them £1,100 and you say, okay, that's it. This is my repayment. And then you go back to zero in terms of your debt. With the government, it's not like this. So when the government spends, every single pound increases the public debt, because the public debt is just the difference between what the government spent and what the government collected in taxes. So, of course, whatever you spend, you will at some point get back, but you don't know when. So there's going to be a difference. There's going to be a deficit. And if the government spends over, decades, there will be some kind of public debt because it spent more than it collected in taxes, mostly because people are happy to save a lot of currency also. So a large part of their income goes into savings or saving and then savings. That means that economic activity will not be at the level where tax payments just equal government spending. And if you want to reduce your public debt, there's no way that you as a government can make payments to reduce your public debt level, because making payments is what created it. So again, when we borrow from a bank, we repay the bank, and that's how we get rid of our debt. But the government, when it spends, it creates the debt. It's just called public debt. It's not a good name, I guess. I think Warren Mosler said we should call it the monetary supply of the government. I mean, when the government spends, it gives us pounds, and then these are in circulation. And if I spend them, then you have them. So it's not a good concept, but this shows you that clearly the difference between the issue of currency, which is basically the government with its central bank. They cannot repay their public debt in a way. They could try to force people to make more tax payments and through this reduce the public debt. That's possible. But again, the government cannot make payments to bring government debt to zero. And that's the biggest difference, I think, that there is between private debt and public debt.
We talked about the government spending money into existence and the private sector borrowing money into existence. And we've got these two sectors, the government, the non-government. And then you bring in the third sector. But first you talk about trade. You ask the reader to consider international trade from the real side and then the monetary side. Can you run through that?
Yes. So if, for example, some companies producing cars in the UK, if you are selling a car to somewhere in Europe, the car manufacturer receives money from the continent. Okay, so that means that there will be, maybe £25,000 more in that account. The economy as a whole has given up the car. So what you export, you cannot consume. So it's a loss from the real side of the economy, and it's a financial gain. When the money is paid in euros, for example, let's just assume for simplicity that it's €1, £1. So some kind of person on the continent is paying 25,000 euros by bank transfer to some British bank, which is the bank of the car manufacturer. Then the British bank will just translate those 25,000 euros into 25,000 pounds. Because the customer, the car manufacturer, probably wants to have pounds and not euros. The British bank now holds 25,000 euros. I don't know how it works exactly. Maybe the account is with the ECB. Maybe it's with some kind of other national central bank, which is part of the euro system. Maybe, Germany or France or wherever the person came from who bought the car. But this is also a possibility to create UK pounds. So this is possible to export stuff. You receive money and then the bank translates that money into your own currency. Of course, it has a currency mismatch on its balance sheet. The British bank now owns 25,000 euros. And as a liability, it has 25,000 pounds in deposits. And if the euro, for example, goes down, then of course it will create a problem for the bank because the assets, the 25,000 euros will be worth less in UK pounds. And then of course at some point assets will be below liabilities, which creates bank problems. But nevertheless, that's also a possibility to create bank deposits in UK pounds through exporting and not through lending.
While we're in this topic, we had an audience question that's related to it from our friend Darren Quinn, who's an MMTer in Australia. And I'm just going to inject a bit of editorial here. I really like the way Stephanie Kelton in The Deficit Myth says, okay, current account deficits are stuff surpluses. That means we're getting stuff for our monetary deficit. So anyway, Darren says, we know if we're running a current account surplus, aka a stuff deficit, i.e. you're a net exporter. So he's right. If we're running a current account surplus, we are accumulating quote unquote revenue from overseas. Some of it, I believe, is likely held as foreign currency and foreign currency reserves. How much of that that is held as foreign currency, how much is converted into the domestic nation's currency? Is the conversion to domestic currency done on the currency exchange market, or is it just notionally equivalized, especially since current accounts are usually measured in the domestic currency, but you can't add up euros, pounds, US dollars, yen, and Australian dollars, for instance. So there's a lot in that question. I'm sorry, I just threw it at you.
No, that's fine. First, we have to understand that the current account is a statistic. That's about payments in the past. So we can forget about it for now. So the question is, what do the exporters do with the money that they receive? And what do the banks do with the money that they receive? Going back to this example of the UK car manufacturer, they have their bank, and the bank already translated or swapped these 25,000 euros into 25,000 pounds. And if the car manufacturer is then using that kind of money to make payments to workers, to pay for inputs or energy in the UK, then of course there's no change there. And then what would the bank be doing? The bank might say, well, 25,000 euros, okay, we're going to need that later on, so we just keep it. Or they go to the forex exchange, to the foreign exchange market, and then they say, okay, who wants to buy this? Then they can get UK pounds for that if they want to. That's in both cases a portfolio decision. But it's more a portfolio decision for the bank because the bank has to do something with that money. It earns an interest rate in the Eurozone, but the deposit rate is negative. It could swap it for UK pounds. I'm not sure what the deposit rate is in the UK right now. Probably not negative like this. Maybe it's a good idea, maybe it's not. It's in the end, it's a portfolio decision. For the car manufacturer, it's important whether this car manufacturer is doing well or not. So if it's doing very well, the car manufacturer might use the 25,000 pounds to repay debts. It might use this to pay a dividend. But if it's somehow accumulating a war chest, for example, to buy some company from Italy maybe, then it's also possible that the 25,000 pounds will be swapped back into euros and they keep it because they want to buy, I don't know, some Italian car maker. But these are all questions which are microeconomic questions. These are portfolio questions. So what will these people do with the money, these car manufacturers? What will the banks do? So you cannot find a straightforward answer. I think Keynes was very good in pointing out that there's one question about the amount of money that you save, but then it's another question which answers what kind of assets do you have? So bonds or money or other kinds of money from other countries. This is the same with a current account here. So with a current account surplus, you know the amount of income that you have received in terms of saving, but you don't know what this portfolio will look like. Again, it's a microeconomic decision. I hope that's more or less clear.
Again, I'm just going to cull something from your book. You wrote, quote, from the perspective of income and expenditure, exports are net inflows for the exporter. Either they lead to higher foreign assets if the residents hold more claims against foreigners, e.g. in the form of US dollars or Japanese government bonds, or they reduce foreign liabilities, e.g. if foreigners pay with domestic currency, which then becomes the property of residents. Exports thus lead to net asset inflows, imports to net asset outflows. Again, it is important to note, and this is what I think is crucial, it's important to note that these are only statistics. A country is not an active agent and therefore cannot have net inflows or outflows. Only residents can experience such changes in wealth. So putting that together, is it fair to say that there isn't an actual current account held by a nation and that's now in surplus because that nation's been net exporting? It's just the national income accounting has derived that the value of the nation's net exports is, in the case of, say, Australia, worth so many Australian dollars. It could be held in all kinds of forms, basically. Is that fair to say?
Yeah, that kind of hits the nail on its head. It's important to understand that these payments already happened. If for some reason you cannot buy something from outside of the country because either your bank doesn't want to do it or you don't have the money, then of course there will be no imports. But everything that is coming up in the current account or the trade account, all these exports and imports have already been paid for. So it's not a question of how you finance a current account deficit. There's nothing to finance. If you have a current account deficit, it just means that in your country, people imported more stuff than they exported. They spent more money on stuff from outside of your country than foreigners spend for buying stuff from your country. And that already happened. There's no open bills or anything, so there's nothing left to pay. Central banks are not getting together at the end of the year and then say, look, you somehow owe us the current account deficit, but you don't have the money. So what do we do now? Countries are not actors. Maybe a government is an actor, but the current account deficit has to do with all these economic units inside a country, with local and federal government, with households, rich and poor, and also with companies and public companies, NGOs, all of these. And it's kind of a mess. Okay, so
I guess there's this kind of preconception. Now that you put it this way, you've made me realize that the way that I've heard a lot of economists speak in the past is as if these flows kind of current account deficits or surpluses or just generally government deficits or surpluses are like flows that you can control if you switch off a certain valve or not and adjust, and they dedicate quite a lot of effort to try to sort of carry out minute adjustments to these flows. But of course, they're not in control of them in the first place.
I think it's a very good point that you mentioned that. If I can get back to the example again about the UK car manufacturer. Okay, so let's imagine for a minute that this UK car manufacturer selling one car to Europe, it was the only export during the whole year. And the UK residents didn't import anything, just to make it easier. In that kind of scenario, then of course you have exports worth £25,000, and that money is sitting on the account which is owned by the car production company. So if you talk about the current account surplus and you want to recycle that, or you want to spend it somehow on something, there's no way you can do it. I mean, the money belongs to the car exporting company, and there's nothing you can do about it. Many neoclassical economists and mainstream economists, they are waking up to the fact that this is how it works. So these private savings that are part of the accounts of the private company producing cars, they have complete control over that kind of money. And if we would say the British public, somehow we would like to spend that money, that's not possible. You cannot spend somehow current account surpluses. That's impossible. You can redistribute money inside the country and say you make sure that these companies pay taxes on those profits so that everybody can benefit. But that's a completely different argument from saying that we want to recycle those surpluses somehow and pay for something with those.
So in your book, you've got a section considering all three sectors: domestic government, domestic private, and foreign sector. And people get very worried. They posit a scenario that their government announces that it's going to, quote unquote, do MMT, which in a critic's mind is we're going to run up deficits and just spend willy-nilly. And actually, all we're saying is let's spend for full employment. That's, we're not saying let's buy everybody a pony. And we've got a very neat little idea called the job guarantee about how to inject money precisely where it's needed into the economy. And really, that's all we're saying. We're trying to replace a really bad aspect of the automatic stabilizers with a far superior way of doing it. But anyway, there's this scenario where people go, okay, well, that's all well and good. We know you can afford your job guarantee. The government's not going to run out of money, but because you've announced that you're going to do MMT, the currency will plummet on the foreign exchange market, leading to imported inflation or hyperinflation. And in your book, you write a little bit about the exchange rate between the Icelandic krona and the euro at a time of crisis for Iceland, and also the exchange rate between the Canadian and US dollar going back a few decades. That just really sort of shows that there's not a lot of correlation between exchange rates and inflation or deflation. Could you talk about that?
Yeah, sure. From the North American perspective, I think the most important exchange rate is the Canadian dollar and the US dollar. If you ask people from Canada or those in the US who live up north, so what happens when the exchange rate is shifting about? Because the exchange rate can jump up or down by plus minus 50% inside a couple of years sometimes. You can ask them, so do you think that there's a hike in inflation? So if the Canadian dollar depreciates, then inflation goes up because the American products are now more expensive in Canadian dollars? And do you think then that it's a bad idea to have this flexible exchange rate? The Canadians will look at you and say, well, I don't know what you're talking about. For them, it's clear that the inflation rate does not depend on the exchange rate. And the question is, of course, so how is it possible? So why do prices not adjust? But this is an empirical phenomenon. Okay, so you don't need a lot of theory to think about these kind of things. So what the multinational corporations are doing in both Canada and in the US, so those exporting from Canada to the US and vice versa, they basically say, look, the exchange rate between Canadian dollar and US dollar will always go this way or that way. But we are producing both in Canada and in the US. And if the Canadian dollar goes down, then of course the Canadian profits will be worth less in US dollars than before, but we have still the US profits, which are then relatively higher. And of course, it's cheaper now to produce in Canada. And it's the other way around when the Canadian dollar goes up. So the companies just say, well, okay, if the exchange rate changes, either we have more profits or less profits. but we just let the profit share go up and down and move with the exchange rate. Of course, we could decrease the prices in Canada if the US dollar goes down. We could make those products cheaper. Then, of course, we would increase market share. But of course, we would lose it again when the exchange rate goes the other way. So why worry about this? So this is about the pricing of international companies. And this is called menu pricing. So it's the same in a restaurant. So when you go to a restaurant, like a pizza restaurant, you will not get daily prices. Okay, it's not like the guys went to the market early in the morning at 4 a.m. and then they buy stuff, and then they make calculations. Okay, pizza salami is, I don't know, £7.85. Yesterday it was £7.83. And then you see like live prices almost when you enter the restaurant. That's not how things work out. So it's kind of costly to change prices, and consumers don't like it. The Canadians would be irritated if the iPhone would go up and down in price by more than 100 Canadian dollars over time. At some point, they would be waiting for iPhone prices to fall, and they wouldn't buy iPhones anymore. And Apple would say, well, what's happening in Canada? We sold 0 iPhones there last year. And then the answer is, well, the Canadians think that the exchange rate of the Canadian currency, the dollar, will go up against US dollar. So they're waiting for that to happen so that then the iPhone is cheaper. And the way to stop this, of course, for Apple is to say, look, we price in Canadian dollars and it's going to be one price and we keep it for 2 years, and then we come down as we also come down in the US when the model is somehow a little bit older.
So the companies basically are absorbing some of this foreign exchange risk.
Yes, exactly. So either they absorb it and say, okay, it always happens that in some export markets, the exchange rate goes down a little bit. But that means, of course, that some other exchange rate must go up. So if you are a global company, for example, then like Apple or Google or other companies, why would you want to have somehow stable revenues from all these countries? It won't happen as long as they have flexible exchange rates. Then, of course, if you want to hedge, you can go to the financial markets and buy forwards and futures and all these kind of things to make sure that you get the money that you think you deserve. So you can lock in exchange rates now, and then you can transform your US dollars into Canadian dollars in 6 months because you have signed the contract now. So you can use financial markets to solve this problem. And that's why in reality, we don't see prices moving too much. So it's really astonishing that in Canada and the US, the inflation rate is almost the same over decades, even though the exchange rate goes up and down by plus minus 50%, I guess. So that clearly shows you that this idea that when you increase government spending, that somehow you're supposed to devalue your currency or ruin the exchange rate, that's not happening, not in the developed world. In Canada, you wouldn't say that this country had hyperinflation as a result of Trudeau, the Canadian president, saying that he rejects austerity and just continues spending. That worked pretty well. And it's also inconsistent from the mainstream colleagues. First, they stress international competitiveness, and then they say, well, if you increase government spending, your exchange rate will go down, and that will lead to higher inflation. But wait a minute. First, you said, when the exchange rate goes down, you have better competitiveness. Is there a net effect or doesn't it matter, or it's completely inconsistent? And for the Icelandic story, I mean, they had a huge banking crisis and they nationalized their banks and they said, well, we do as much as we can, but look, we have a couple of 100,000 people on this island and the balance sheets of these 3 Icelandic banks combined are roughly 10% our GDP, most of it in US dollars. So sorry, I think I once made a calculation that the debt from those banks would be roughly $40,000 per resident in Iceland. So if the Icelandic people would have paid off the debt that the 3 banks accumulated, they would have been losing $40,000 per person. And this includes, of course, children and old people. I'm not sure if the calculation was right, but it was something around that sum. And of course, it's ridiculous. I mean, these are private banks making private contracts. Why should you make the public pay for it if they cannot honor their private contracts? We have insolvency laws. That's what they are for. So if there's a business and they can make their payments, well, they are bankrupt. You go into insolvency proceedings, period. That's it. That's the end of it. And the exchange rate adjusted in Iceland. It went down. It lost half of the value that it had before. And inflation rate went up to 10% for a couple of months, and then it came down to 3 or 4% inside of 2 years. And that's also what should happen in a financial crisis or an economic crisis. So you want to depreciate your currency so that imports from foreign countries are more expensive, so people buy more local stuff. And also your local stuff in foreign markets, it's more cheap now. In US dollars, it's now half the price. That leads to an increase in aggregate demand when you need it most in your economic crisis. And it stabilizes the country. And Iceland has shown that this has worked pretty well. So of course it was a very huge contrast with Ireland, the other island, which was in the Eurozone and kind of forced to nationalize the banks and then actually pay those debts in euros that the banks had. There were letters from the ECB sent to Ireland, threatening letters, and that's also part of the dark side of the euro. The political dimension of the Eurozone doesn't work. The ECB somehow is too powerful because it can create the troika and help doing these things. So, yeah.
Incidentally, I think the idea of a pizza restaurant with live prices based on the foreign exchange market would be a fantastic themed restaurant idea. And I think a great quote before we wrap up from the book. Let's say goodbye to the taxpayer myth. It's our money. Who saved the banks with their money? We did. Who solved the euro crisis with their money? We did. Who paid for the welfare state? We did. Who will pay for the Green New Deal? We will.
So I wrote this book with non-economists in mind. The book is very short. I think it's 60 pages and it's kind of smallish. So it's for people who want to understand what MMT is, what it says. I don't have the balance sheets in there. So it's addressing the public and interested academics. I hope that this kind of fills the gap and makes it more popular. And of course, I'm standing on the shoulders here of giants like Warren or Randy, Bill and Stephanie, of course, and Pavlina. So I'm very, very thankful for all the work that they've done. And I hope that I can add just a little bit to this kind of mosaic.
We've been talking to Dr. Dirk Ehnts, MMT economist and author of, most recently, MMT Essentials. Hopefully, we've made the case for an English translation, but we'll link to where you can find all of Dirk's work in the show notes. But for now, thank you so much again for joining us on the MMT podcast, Dr. Dirk Ehnts.
Thanks. It was a pleasure and a lot of fun too.
That was the MMT podcast with Patricia Pino and Christian Riley. Don't forget, you can support the show through Patreon, starting at $1 a month and get access to patron-only episodes. You can do that by going to patreon.com/MMT podcast. You can also find me on Twitter at MMT podcast, and you can find Patricia on Twitter at Patricia N. Pino. And you can email us at mmtpodcast@outlook.com. Thanks for listening, and we hope to hear from you. Can't find the stop button.
It doesn't matter. We'll carry on.
Just keep talking for a second. Oh, there it is.